Welcome back. Thank you for tuning in to learn about the accounting cycle. Be sure to check out our other videos in this series. By the end of this video, you will understand the objectives and principles of financial reporting and the steps for preparing a financial statement. We will look at how financial information flows within an organization, the difference between business events and transactions, and how transactions are captured and classified in an accounting system. You will be able to identify assets, liabilities, equity, revenues, and expenses, and what happens after the transactions are properly classified. Let's start by understanding the objectives of financial reporting. The primary goal of accounting is to create and provide information useful for both internal and external users. This is done by applying qualitative characteristics, the fundamental, or must-haves, and enhancing, or nice-to-haves, characteristics. The must-haves include relevance. This means the accounting information should help users predict future events and confirm past events. Faithful representation means the accounting information is complete, neutral, and free from errors. The nice-to-haves include comparability, which means information should be comparable with other periods and similar business. Verifiability, another enhancing characteristic, refers to whether information can be verified by different experts. Timeliness says that information must be produced in a timely manner for users to make decisions. And understandability requires information to be as clear and concise as possible so users easily understand. In addition to qualitative characteristics, here are some key principles in financial reporting. Business entity means the owner is separate from the business. Time period. Prepare financials at regular intervals. Going concern. A business will continue for the foreseeable future. Money measurement. Recognize transactions that can be measured in monetary terms. Prudence. Record losses as soon as you know and record profits when they are made. Accrual. Income and expenses are recognized when earned and incurred, not when paid. Matching. Record an expense in the same period in which a related income is earned. Consistency. Standards and principles should be consistent from one period to another. These rules apply to all organizations, and they are critical to understanding the fundamentals of accounting. From a management perspective, it's equally important to understand how information flows within an organization. The process starts with a business event followed by a transaction. It is then classified and recorded, followed by any necessary adjustments, and ultimately creating a financial report. A financial report summarizes all transactions occurred within an organization in a format that is easy to understand and follow. This is the most basic form of the accounting cycle. To produce useful financial reports, it is extremely important that we differentiate between events and transactions. All transactions are events, but all events are not transactions, because to be a transaction, an event must be of a financial nature. When an event brings about changes to an organization's account balances, it is classified and recorded in the books as a transaction. With the help of this next example, let's look at what happens after a transaction has occurred. We start with an event. An organization made a decision to buy a truck. It becomes a transaction when a payment is made to the dealership. The source document that codifies this transaction is a signed bill of sale. Once the sale and paperwork is complete, the transaction is classified as an asset in the organization's books. Today, all of this happens concurrently through accounting software, but the human element is still important. Someone has to classify every transaction and ensure that it is recorded correctly. When it comes to classification, there are 5 categories. These include equity, assets, liabilities, expenses, and revenues. As an organization, you must classify all business transactions into these categories, and they'll be organized in the same manner in your financial statement. Now that you've got the language of business, let's look at these in detail. What is equity? Also known as owner's capital, it is the resources invested in the business by the owner. Note that in accounting, the owner and business are 2 separate and distinct entities. Therefore, the funds contributed by the owner into the business are seen as coming from outside the business. Assets are tangible and intangible resources that an organization owns. Current assets point to resources that have a shelf life of less than a year. Assets can also be long-lasting, but those are categorized as non-current or fixed assets. Land, buildings, equipment, debtors, and inventory are all examples of assets. Now let's look at liabilities. These are debts that an organization owes. Similar to assets, the liabilities of an organization can be further categorized as current and non-current. Creditors, loans, overdrafts, and financing are some examples of liabilities. Equity, assets, and liability form the basic accounting equation. It's the foundation of a balance sheet, but more on that later. Revenues are a measure of the inflow of economic benefits arising from the ordinary operations of a business. Different types of organizations will generate different forms of revenues, but all forms will result in either an increase in assets or a decrease in liabilities. Property taxation, sales of goods and services, royalties, bank interest, and grant funding are some examples of revenues. Finally, expenses are normal organizational costs incurred in buying or producing and selling of goods and/or services. They represent an outflow of economic benefits arising from ordinary operations and will either lead to a decrease in assets or an increase in liabilities. Cost of goods and/or services sold, operational costs, and sales and marketing costs are some examples of expenses. Earlier, we mentioned the basic accounting equation. Let's explore that now. A business commences when an owner supplies resources into the business. This is called equity. In the absence of any other resources, what the owner supplies are equal to resources that exist in the business. The latter is called assets. However, sometimes a non-owner can supply resources for the business. This is called liability. If this is the case, then the resources supplied by owner and non-owner will always equate to the resources that exist in the business. This is the basic accounting equation. The two sides will always balance out, and therefore it is the foundation of a balance sheet. After events and transactions are classified into the 5 categories, organizations often have to make adjustments. These are changes to accounts at the end of an accounting period to ensure that principles of financial reporting are followed. Some transactions may not be recorded on a daily basis as it may not be efficient to do so. An example of this would be wages and salaries. Similarly, some costs are not recorded during the accounting period as they expire with the passage of time rather than as a result of daily transactions, such as depreciation. Furthermore, at the end of an accounting period, there may be some items that are unrecorded, for example, utility bills that came in late. Adjustments are an essential step in the preparation of financial statements. The inflow and outflow of money must be reconciled for the owners or ultimate beneficiaries, and accounting helps with this process. Speaking broadly, there are 2 types of adjustments: deferrals and accruals. Deferrals are prepaid expenses and unearned revenues. Prepaid expenses are paid before they are used or consumed, whereas unearned revenues are payments received before services are performed. Accruals are accrued revenues and expenses. Accrued revenues are for services performed but for which payments have not been received, whereas accrued expenses are expenses incurred but not yet paid for. After adjustments are made, organizations begin the process of preparing financial statements, and it starts with the income statement, which sheds light on how much wealth is created in a given year. This is followed by a statement of changes in equity or retained earnings. This helps one understand the fluctuations in equity year after year. Financial report is the statement of financial position or balance sheet, which summarizes the accumulated wealth of an organization. Statement of cash flow explains the movement of cash. And lastly, notes to financial statements explain in detail all aspects of financial reports. This concludes the accounting cycle. To sum up, it all starts with an event leading to a transaction, translating that into respective journals and ledgers leading to trial balances, followed by adjustments, which leads to the preparation of financial statements and the eventual closing of books. This process is repeated annually, and that's why we call it a cycle. We hope this video has been helpful in understanding the steps involved in the accounting cycle. Subscribe to our channel and find us on our socials for future tutorials. See you next time.